Welcome to the Enriched Wealth Podcast. We're excited today to be joined by special guest Brett. Brett's one of our senior advisors and partners at Strategem, and I've got him here today as a guest and looking forward. So welcome, Brett, to the podcast.
Thank you, Kris. Thanks for having me.
Mate, so you have been at Strategem for how long now?
It's going to be 13 years in June.
Wow, 13 years is a long time. It's probably longer than most Hollywood marriages, I'd say.
I think you're right. It's certainly the longest innings I've had in my working life. Certainly 13 years is a good innings.
Yeah, it is. And obviously through the financial planning, wealth management side of the business for all that time, that's sort of been the focal point?
Yeah, pretty much. Yeah, I've done about 25 years in financial planning.
Yeah, wow.
And I spent about 5 years over in the UK in funds management.
Yep,
so
which is
financial services for nearly 30 years.
Wow. So I want to dig into a bit of that journey. So let's wind the clock back just a couple of years. So uni, what did you do at uni? Where did you go? What did you do? What was the course? What was the calling?
So I went to Deakin Uni in Melbourne, Burwood, and I started doing a Bachelor of Accounting degree.
Yes.
But I think sort of towards the end of the first year, I realised that accounting's probably not for me.
Yep.
So I needed to pivot and moved across to a Bachelor of Commerce with a finance major.
Great. And so you, at that point, did you know you want to be a financial planner, or was it more, I just want to get more in this finance space and away from the tax and the compliance and the financial statements?
It was more let's get away from the tax and compliance. No, look, I had a bit of an interest in personal finance, stock markets, that sort of thing. So probably in the third year, the last year, I sort of realised that, hey, personal financial planning was a fairly small industry at that point.
Yes.
So it could be a good growth opportunity for me.
Yeah, you would have been in some of the formative days of that financial planning space, wouldn't you? It sort of was really quite different to how it looks now.
Yeah, I joined the industry in 96 and there weren't too many financial planners out there in the mid-90s.
No.
So I think how the industry developed was...
It came from an insurance background,
Yeah, I was about to say, it came out of the insurance industry.
Yep.
So obviously the insurance is pretty much insurance, whereas financial planning is a bit more than just insurance. So,
I think it's taken a long time to shift people's perception on what planners do, isn't it? Because there's still probably a bit of they're just insurance salespeople or things like that, where the insurance aspect's actually quite a small piece of what goes on these days, and there's all these other facets to it as well. So we come out of uni, first job. Where did you land?
I landed in the superannuation administration team at Mercer, which is a big global consulting firm. So
you cut your teeth in a big place. Obviously, lots of exposure to lots of different things there as well too. Yep.
Sure. Yeah. No, it's a big wealth management firm at the end of the day. And I remember first walking through those doors at 101 Collins Street in Melbourne, thinking this is a good move. Really nice offices there. I think it was on the 27th or 28th floor.
Nice.
So beautiful views to the south across the Yarra River and the botanical gardens. So I was pretty happy there, but spent 6 months in the admin team and then moved across to the financial planning team.
Great. And so then started seeing clients,
I wish. No, I was only 22 years of age at that point, Kris. So long time ago.
Only 10 years ago or so.
I wish. No, a long time ago. So no, look, I did what a lot of people do. You sort of get your foot in the door somewhere, and then you sort of work your way up the ladder. Yes. So I went in as a paraplanner, which your job is there to support the financial advisor or the financial advisors you're working with.
Yes.
So basically, take as much work off them as you can. So I did that.
So you're writing plans, obviously.
Yeah, writing financial
SOAs
plans.
probably looked a little bit different. Statements of advice, I should say, look a little different to they do these days.
They weren't called statements of advice back in those days. They were just called financial plans. Worked with a really good financial planner for a number of years. He ended up moving up to Sydney to lead our Sydney office. And a new planner came in and I started working with him.
Excellent.
And then about 4 years into that job, I was offered a transfer to the Perth office. because I was on my way to the UK, and they opened a financial planning office in Perth, and they needed someone from Melbourne to go across and help them out.
Okay.
So I ended up going across to Perth for about 12 months, and effectively helped start the office over in Perth.
Wow, that would have been a great experience, just being part of something that was starting out, seeing that growth phase and those kind of things as well too.
It was, yeah. Look, I think I'd only been to Perth once prior to that, and that was on a mystery flight. So for those older viewers, you probably know what a mystery flight is. But my wife and I went over there for a mystery flight one day. But we really loved it when this opportunity came up to say, well, can you go over there and live there initially it was 6 months, but we loved it so much we stayed on for an extra 6 months.
Great.
But yeah, it was great, mixing with different colleagues on the other side of the country and helping them build the financial planning office from scratch.
Yeah, that's awesome. And then from there, you said London.
Yes, London. Yeah, so I probably need to acknowledge my wife Kylie on this one. So, she'd already done a bit of overseas travel.
Okay.
She was really keen to live somewhere else, and sort of dragged me along on the adventure, I guess. And my grandfather was Scottish, so I got to go over there for 4 years on an ancestral visa.
Great.
And we ended up working in asset management over there. So in the city of London, London being one of the major financial centres in the world. Yeah. It was a great...
and it was probably quite, maybe not necessarily right at the peak, but quite a height in the industry over there in terms of all of what was going on there. You know, we'd just come out of the 80s with the bond markets and the crash, and it was probably that 90s boom time. So what was your how did it differ from your experience in Melbourne for people who might be thinking?
Well, we arrived late 2000, and I remember it very clearly because we arrived in November 2000, and we were very keen to get work.
Yep.
So we started putting the feelers out to recruitment consultants, and they said to us, look, no one's hiring this time of year. It's, 6 weeks out from Christmas.
Yep.
So we had to sort of travel the UK on the Aussie dollar for about 6 weeks. So we chewed through the money very quickly. But in the new year, so early 2001, we ended up both getting jobs in asset management.
Great.
The tech bubble had burst recently. So that's where, particularly in the US, a lot of the tech companies got sold off in a very big way. So they all fell by about 70%. So a major stock market correction, and that filtered through to the European and the London market as well.
Yep.
And that was the environment that I walked into. But it was a great introduction to asset management. I worked in the client servicing team on the institutional side. So rather than dealing with mums and dads here in Australia, I was dealing with big institutional investors.
Okay. So really the other end of town a little bit in terms of size, volume, expectation. They're just looking for you to get the best return for their money. You're just in some ways a faceless person to them. They just need the deal done, as opposed to that very personal financial planning space that you've been in here.
Yep.
I started at Strategem coming into the GFC, so probably similar sort of, you cut your teeth in this environment where I think sometimes when you come in and there's an event like that, it's like, well, it can only get better from here. And if you've seen that, then the rest seems quite easy in comparison. So what were some of the things that you learned from that time over there in terms of that asset management? Because you've just been really in the deep end in terms of markets are very volatile.
Yeah, correct.
You're coming in without that perspective of the last however many years of doing it. So what were some of the things that you learned in those early years?
Well, I came in pretty green, to be honest, because all I knew was the Australian market.
Yep.
And in particular, the Australian financial planning market, which was very much mum and dad type investors.
Yep.
So when you go to London, New York, Tokyo, these major financial centres in the world, you start to realise that Australia is a pretty small slice in the world market.
Drop in the ocean, isn't it?
Absolutely. So I remember having a chat to one of the fund managers early on and asking them about, how do they invest into Australia? What do they buy? And the response was, we don't buy anything. So it sort of gave me a real indication about how big this financial market is on a global scale. Now, back in those days, BHP had a dual listing here in Australia and also on London. So you could get exposure to BHP via the London exchange. But Commonwealth Bank, Westpac, NAB, all the big banks, they wouldn't even touch them. Yeah. It was all about the UK banks, the European banks, and the American banks.
Yep. Which is something I think for investors here we need to keep in mind, because so often, and I saw some stats the other week about SMSFs and their asset allocation, and SMSFs usually have more of a bent to Australian shares than they do international shares, and they were actually saying that it's probably hurt some of their performance over the last couple of years because they haven't had that same exposure to the global market. And I think sometimes when we look at asset allocation, we can forget that there's whole other worlds out there going on that's not Australia that we need to be thinking about when we're building that asset allocation. And in reverse, they're probably not even thinking much about Australia in terms of an investment opportunity.
You're absolutely right. Investors, whether they're retail investors or wholesale investors, tend to invest in their own backyard because they know Commonwealth Bank, they know Coles, they know Woolworths. And again, this was a bit of a lesson when I went to the UK as well. Over there, they tend to invest in UK equities.
Yes.
With a bit of global equities as well.
Yes.
But very, very small exposure to Australia, if any. And also fairly small exposure to Asia, excluding Japan as well.
Yeah.
Very much European, US, and Japanese equities was the formula when it came to their portfolios.
Okay, interesting. And so, how many years in London?
We ended up about 5.5 years.
Yeah, wow.
Yeah, as I said, I was there for 4 years on a visa, and then they give you permanent residency after 4 years, and then if you hang around for an extra year, they give you citizenship.
Wow.
So both Kyle and I managed to pick up citizenship after the 5 years.
So you can go back anytime you want?
Yeah, I can. Yeah.
That's great.
Yeah.
That's really good. And what was the call home?
Family.
Yep.
Yeah. So my daughter Bella, who was about to turn 20, she was born in London.
Okay. So does she have a London citizenship? Or?
Well, she's born there. So she's English by birth. And when we got home, we got an Australian passport for her as well.
Great.
But yeah, we Kyle and I were just living in a 2-bedroom apartment in London, and we've got this newborn baby.
Pretty small apartments over there, aren't they? From what I've seen,
this one was pretty good actually.
Okay,
yeah, it was it was kind of in suburbia, call it that, in London. So it was a good size apartment. But we had some really great friends there, and we still keep in contact with some of those friends, but just no family.
Yes.
So the pool was, now that we've got a newborn, we probably need to be, close to mum and dad and other family. Yeah.
Yep. And the support networks do change when kids come along, don't they?
They sure do, yeah.
Where it was okay to have friends. Friends probably don't want to come over at midnight if something's going on, or those kind of things as well. Not saying friends won't do that, just sort of saying family's usually the ones that are around in those circumstances. So.
Yeah, spot on. No, it was a great period of our lives. We travelled a lot of the world with British pounds in our pocket. Yep. So back then it was a very strong currency, as it is still. We've seen a lot of the world, which we're very lucky to have done. And I think it was time to come home. And as I said, that's 20, not quite 20 years ago, but close to it.
Yeah, wow. Yeah. And then so come back to Australia. Where did we land?
Yeah, well, I ended up back at Mercer.
Okay, there you go.
So one of my former colleagues who was now heading up the advice team, heard that I was on the way back to Australia. So he made contact with me and got me in for an interview and. Got a job pretty much straight off the plane. So was able to slip back into Mercer into again initially it was probably an associate advisor role. Yep. But about 6 or 9 months later, moved into a full-time advisor role.
Perfect. And so then obviously you would have seen a lot of change there at Mercer in terms of when you first started in '96, superannuation was just this little bit of an idea the government had sort of started making employers do, where by the mid-2000s it had actually started to become quite a significant portion of people's portfolios, and it's continued to be so. So you were seeing quite a change, one, when you came back, and then two, moving on from that. over those next few years. So how long were you at Mercer through that period?
So I spent another 6 years there.
Yep.
Yeah, so 4 years initially and then came back and another 6, so 10 years. But in terms of the change, it was massive because when I left in 2000, how financial advisors got remunerated for their work was very much commission based.
Yes.
So you would lodge an application form with a fund manager or a superannuation fund, and you would receive an upfront commission, and then you would also receive a trail commission. So that was the environment I left in 2000, and when I returned in 2006, it all become fee for service. So again, I remember the first conversation I had with a client to say, well, if you want me to do this work, it's going to cost you $3,000.
Yep.
That was a bit daunting at the time because when I left, it was all about, well, we're going to get paid by someone else, the fund manager or the superannuation fund. So that was a massive shift in a fairly short period of time.
And I don't think people probably appreciate that we don't do commissions anymore. Like in that finance, if we're going to give investment advice, if we're going to give advice around super or things like that, it's not because we get paid or that's a good deal for us. It is literally you pay us to do the work, but we're not here to pick one because it gives us a benefit in the background or anything like that. Those days are long behind us.
Long gone, yeah.
And it's quite an independent process, and I think quite a robust process because of that. And you would have probably seen a bit of that shift as well too, where it was like, oh, well, that means I'm not thinking about having to do this. I've got all of these choices because it's just about the client now. It's just about what we can put the client into.
Correct, yeah. It's full transparency now. So again, if someone needs me to do work, we'll scope the work. We'll come back to them initially with the terms of engagement, which identifies their goals and objectives and the work that we're actually going to do, and we'll let them know that this is the cost for us to do that work. So up front, they know exactly what we're going to do for them, and they know what the fee is going to be. Very different to the mid to late 90s.
And then from there, Mercer for 6 years?
So spent 6 years at Mercer, and then I was we moved out of Melbourne. I got to the point, and again, this is many years ago, so there's probably a lot of people out there now that are probably feeling a bit like this, but I got to the point where I was going off to work every day and I felt like I was just doing that to pay a mortgage. And my son had come along around that time, so I was the sole breadwinner in the house. But we had an average mortgage, and back in those days, the average mortgage was $300,000, not $650,000.
Showing your age, Brett.
Exactly, not $650,000 as it is today. But Kylie suggested to me, now we've got 2 kids, we need a bigger home. Let's do an extension, which was going to cost $150,000 at that time, or we move a house, and that's probably a bit more. So here I am in the background going, well, okay, I'm taking my mortgage from $300,000 to potentially $450,000 or $500,000. That doesn't make sense to me.
Good financial advice there.
So I did
say that to a client. I said usually the best experiences are the worst financial decisions, and the best financial decisions are some of the worst experiences. So best financial decision is just never quit work. Work until they bury you. But that's not fun. So you got to find a bit of that balance of saying, we're working for life, not life living to work kind of thing.
Correct. So look, I suggested to Kylie, hey, how about we move out of Melbourne? To a place where I can still commute into Melbourne. So we started looking around. We looked at, I remember looking at Ballarat. We looked
a little colder in Ballarat.
Yeah, a bit colder, but we ended up in the Macedon Ranges.
Okay, so the tropics in comparison.
So in particular Wood End. So Wood End's a beautiful spot. It's about 600 metres above sea level. And it is a very cold place.
Beautiful spot though.
Beautiful spot, beautiful village, beautiful people. Very much a commuter town, but I probably didn't appreciate how cold it actually gets. So we moved out, and it was a good spot at the time because the kids were young. My daughter just started primary school. My son was starting kindergarten. So it was a good period of our life. It was a really nice spot, and then I can still commute into Melbourne.
And you would have probably found, was the commute that much different from being there and getting a direct train in, or?
It was a long commute. I think I did it for a few years, but door to door it was about 2 hours.
Yeah, wow.
So I'd walk down the station, catch the train to Melbourne, and then walk from the station to the office. So door to door was about 2 hours. So 4 hours commuting every day.
It's a long time.
Yeah, so I did it for a few years. But it got to the point where I kind of thought, I'm a bit over this. And Wood End to Bendigo was only about an hour on the train. Even quicker if you drive. At
the speed limit.
At the speed limit, of course. We don't exceed the speed limit. I sort of just went on to Seek, I think. I don't think it's changed its name in those years, but and there was a job for a financial planner at Strategem.
There you go.
So I decided to apply for it, and here I am 13 years later.
Rest is history.
Exactly.
No, that's really good. And if we talk about your current role now, so obviously you've probably had a bit of a transition in that time to now. What do you do now? What does day-to-day look like for Brett? What are some of the things that you're seeing out there for people today or dealing with for people today?
Well, look, I don't think a lot's changed over that 13-year period. At the end of the day...
and I think that's something people need to remember is that for all the change that we hear about legislation and things like that, superannuation is still a great retirement vehicle. Share market is still running. Property, all those, like a lot of these things haven't changed over a long period of time. Maybe some of the facets have changed, but a lot of it is still just that. It is just getting good advice, going into the good investments, managing, keeping an eye on them, making change when you need to. There's not sort of this whole new way of doing things that we didn't have many years ago.
No, you're right. The fundamentals haven't changed. At the end of the day, if you're able to put a bit of money away on a regular basis into a good quality asset that grows over time, you'll do well.
Yes.
What's probably changed a bit is behind the scenes in terms of compliance that myself and all the other financial advisors have to deal with every day. So that continually evolves.
The choices change too. That's probably one thing I've seen evolve over the years is where
market's grown.
Where when I first started, it was very hard to get into international markets like you could, where now there's an ETF for everything, there's a managed fund for everything. You've basically got all this choice, but that creates a whole new set of confusion I've found as well.
Absolutely. Things have moved along in terms of the products. But certainly getting access to wider markets has become a lot easier. Look, I look after about 100 portfolios. A number of my clients have multiple portfolitos, but they're all a little bit different at the end of the day. There's some fairly common investments.
Different goals too at the end of the day,
different
isn't it?
goals,
So it's not everyone's looking for that risk-on approach and not everyone's looking for that risk-off approach either. There's a whole range of people in that midsection going, this is what I need for now, and that changes here and it changes there, but it's walking through that with them.
True. Yeah, look, I think my oldest client is about to turn 90 in a couple of months.
There you go.
And my youngest client is probably about 25. So
full range.
Yeah, the 25-year-old goals and objectives are very different to the 90-year-old, right? And there's a lot of people in between. But one of the first things we need to understand is what are your goals and objectives when it comes to investing? One thing that we really focus on initially is what's your appetite to risk or what's your risk profile.
Yes.
So before you invest one single dollar, you need to understand what your risk tolerance is because if you're a balanced investor, for example, ideally you want to have around 50% in cash and bonds, defensive assets, and shares and property growth assets. But an interesting story on this one. I remember doing a risk profile questionnaire for a client who just sold a business in town. They were pretty conservative. On paper, they told me they were growth investors, so 70% in growth assets. And when I showed them that pie chart and talked to them about the risk and the returns, they nearly fell off their chair. They said, "Oh, that's just far too aggressive." I said, "Well, that's what you're telling us on paper." Yes. So we brought it back to balanced, 50% growth assets, still too aggressive, and we ended up landing on moderately conservative, which is the opposite to what they told me. So it's very important to understand what your risk tolerance is.
I think that's a big piece. Like I was going through that with clients yesterday actually, and we were looking at where their super's invested at the moment, and there's just probably a lack of good knowledge out there around what's the default option my super fund puts me into, and a lot of times it can actually be quite risky, and so it looks really good because there's been some good returns here or something like that, but it's because we haven't had a down market for a few years. Where I think if we have that down market, there's going to be a lot of people going, I didn't realise that's what I was invested in. I didn't realise I was taking on that risk. I didn't realise that extra 1 or 2% meant I'm taking quite a haircut this year because of returns and things like that. So I think it is, people need to really understand their risk profile. And obviously the best way to do that is sit down with an advisor and go through the whole process. But there is a process to this. It's not just about being at a barbecue and saying, Brett, what share do I buy? Yep. It's going, well, where do you want to be? What do you want to do? Because I can tell you to buy a share, but it might take 3 years to come to fruition, and you need the money in 12 months' time to make a deposit on the house or this or that. Well, that's not going to work. Or if that's your retirement money that you're relying on for retirement, the last thing you want to do is see that disappear just because you've taken on unnecessary risk. And so I think having appreciation for that process is huge.
Yeah, so that's a really good point. Interestingly, when I talk to clients about where is your super invested, they kind of know what fund they're in.
Yes.
And then I say, well, what's the investment strategy or an investment option? Sometimes they struggle with that.
Yep.
But then most people have no idea how that fund is actually investing their assets.
Yes.
So,
and there's a lack of transparency too. Australian shares could look very different from one fund to the next.
Yeah, correct.
We were looking at even like there's private equity now, and that's sitting at quite high levels in some of these funds where it's like, well, you don't know the companies in that private equity, and they could be on the verge of bankruptcy or whatever, but you don't actually know. I'm thinking of a large super fund that just wrote off $1 billion private equity investment, and it was kind of like, oh, well, these things happen, and it's like, yeah, well, not for people who know what's going on with their super. So.
And I think that super fund that you're talking about, their default option is the balance fund.
Yep.
And again, in our world, balanced is 50% growth assets, 50% defensive. But in their world, it's more like 80% growth assets, 20% defensive.
Which is a huge allocation of growth assets. Like so that's nearly on the aggressive side of things.
So that's all fine and good as markets have been really strong over the last couple of years. But if we have a major correction, which will happen at some point, a lot of those members have no idea that they have 80% in growth assets.
No, and it's only when there's that downturn and then that negative return pops up, and I didn't realise that. So, what does day to day look like for you, Brett? When people hear financial planner, they've probably got visions of 4 screens with markets going on, and shouting down the phone buy and sell. But what does it actually look like day to day for you?
Yeah, it's not like that. It was a bit like that in the UK.
Yeah, I could imagine.
Particularly on the trading desk and the fund manager desk, they had multiple screens in front of them, and lots of activity, lots of noise. No, look, my day, I usually spring out of bed. The first thing I do is look at my phone and have a look at what the international markets have done overnight. Yep. So the US stock market is about 65% of global equities. So whatever happens over there really drives what happens in other parts of the world.
Yes.
So it's always nice to know what the S&P 500 did or what the NASDAQ did overnight.
Which I think is too why we get a lot of US news. And I think some people think, is that just because the US talks the loudest? And it's like, no, the US is quite a big impact on everything. Like when it's 65%, that old adage of when the US sneezes, Australia catches a cold is still there because it is very much a down the line.
It's a dominant stock market.
Yep.
That's kind of what I first do. And then when I get into work, it's a case of just trying to work out what I need to do to get through the day.
Yep.
In terms of check my calendar, what's coming up, make sure I'm prepared for the review meetings I've got today or the next day. And having a look at what new business work I need to be working on as well.
Yep.
Pretty much just making sure that I'm looking after my existing clients and then doing the work I need to bring on new clients as well.
Yeah, excellent. And so when we talk about, let's talk about investments for a minute, because I think too sometimes people come to a financial planner thinking that we're these investment experts that sit there and read investments all day, but if we did that, we wouldn't have time to sit in front of the clients. And so what have you seen shift for Strategem over the last few years in terms of what we do around our investments, where we get our investment research from and things like that?
Yeah, well, that's certainly evolved over the last 13 years as well. So, when I turned up 13 years ago, each portfolio is very much a bespoke portfolio. No portfolio was exactly the same. So there was a lot of work to maintain that.
Yep. But not necessarily for better returns, though, was it? Always?
No. But we were relying on a third party research to build portfolios and to manage portfolios. But of late, and this is just not Strategem, but also the industry is moving towards what's known as managed accounts. So this is where a financial advisor group such as Strategem partners up with an asset consultant. Because they're the people that you've just mentioned in terms of they live and breathe investment markets. Whereas I kind of view myself as a bit of a generalist. I do a bit of investment stuff, but I also do a lot of strategic work, superannuation advice, aged care work, age pension or Centrelink work, estate planning. So I'm a bit of a generalist. So we've recently adopted managed accounts, and our asset consultant is the investment specialist that we lean on now.
And I think that's one of the things is we know our limits and we know when we need to bring in those experts in different areas. And I think this is one of those things where we know running bespoke portfolios, the compliance changes over the years has just meant that it's harder and harder to be agile in those scenarios where a managed account means we can be agile and give a great outcome for clients without also drowning in paperwork, drowning in compliance costs and things like that. And so really it's about how do we get the best outcome for the client in this scenario? And I think to bring on those asset managers who are day-to-day knocking on doors with fund managers and different things and saying, what are you doing? How does this work? What are you doing here? They're the kind of things that we want to lean on experts for. We don't have the time to do that, plus actually help the people who need it on top of it. So I think that's...
that's absolutely right. How I've been describing these managed accounts to clients recently is that, and I've been going back to my days in the UK, so... The second firm I worked for in the UK was Citigroup Asset Management. So it was
people might know that.
Yeah,
name,
they
Citigroup.
might know Citi or Citigroup. So at the time, Citigroup was the largest financial services company in the world. I worked in the asset management division. And I was the account.
You were seeing a lot of zeros.
There's some big numbers. And I was the account manager for Europe, Middle East, and Africa, so EMEA.
Okay.
So some of my clients were central banks in Asia, central banks in Europe, and we're talking big numbers. But this whole managed account investment structure is a bit like institutional investing. So your big institutional investors, they don't go directly to the fund manager; they come through a consultant, the asset consultant. So if the Central Bank of China, for example, wants to invest money, they go out to a consultant and say, look, we want to invest a certain amount of money in this particular asset class. Can you come back to us with some recommendations? And that's exactly what these managed accounts is for us now. So we're leaning on our asset consultant to give us some good ideas and help us manage those portfolios going forward.
And I think too, as the choices got bigger, the noise has got so much stronger as well too. Like there is just so much out there that can and can't impact things, and it's like if you chased every rabbit hole, you'd be forever chasing noise. And I think that's one of the things. Like you've got a chart. I know I've seen you. If you want to talk a little bit about that chart, that you show clients around the markets. Like if you had $10,000 here, what it looks like now. Can you see the GFC in the middle of that? Can you see the tech stock bubble and things like that? Like over the long term, it's about being in the market, invested in the market, but it's about picking those right areas. But also too, because we've got all this extra noise, sometimes we think, well, this is all going to impact us when it may not. And that's where that additional expertise comes in to go, no, let's cut the noise. Here are the great investments because of what they bring to the market. So do you want to talk a bit about that chart?
Yeah,
I think that's
a good chart. Look, I'm not going to take responsibility for putting it all together. It comes out of Vanguard, but
and we'll include that in the show notes as well too. That I think that's just a good little summary one there.
So Vanguard's one of the largest fund managers in the world, but every 12 months they update their long-term performance chart, so it gives an indication of what the asset classes have returned over 1 year, 5 years, 7 years, 15, and even 30 years. So
long time frames.
Absolutely. So it's a good chart to refer to, and I think Aussie shares have delivered around 9.2% every year for the last 30 years. US equities have delivered about 10.2%, but they've had a terrific run pretty much since the bottom of the global financial crisis. But certainly more recently. I talk to my clients clients about taking the long-term view when it comes to investing. As I said, determining your risk profile is really important. And then, one of the golden rules to investing is do something. Just do something, right? So I'll use my daughter as an example here. So
Go for it.
She finished school a couple of years ago and she's now working full-time.
Yep.
And I've said to her, look, can you put away $70 a week into a long-term investment plan? So we're not talking a lot of money here. We're talking $10 a day, right?
Yep.
So some people in our office spend more than $10 a day on coffees, right? So if you can save that a day and invest that over a long period of time and then put it into an investment vehicle that earns 9 or 10% per annum, you're going to have a lot of money in the years to come.
Yeah.
So I've said to her, if you do that every fortnight for the next, I think it's 40 years, she'll have about $1 million, right? So you're sacrificing $10 today to have $1 million in around 40 years' time. So that's just the power of compound interest.
Yes.
So the longer...
I think it's the eighth wonder of the world.
Yeah, I think
Charlie Munger.
I think Albert Einstein even said that.
There you go.
As well. So, compound interest
Smarter
is
men than us, mate.
Yeah, very much so. Yeah, so if you can put a little bit of money away for a long period of time, it starts to add up.
And I think that was one of the things, like when I got to Strategem, I used to look at client portfolios, and my first question was, what do they do? And there was a range of professions, and what I learnt quite quickly on was that it's actually around what you do in terms of investing, not what you do in terms of a job that matters for some of this. And we've got very successful clients in lots of different industries, lots of different fields, and lots of different vocations. And it's around how they've been with and applied themselves, not necessarily that they were all star performers in X, Y, or Z. It was that they were actually great at just chipping away on a regular basis.
Yeah, no, that reminds me of a situation that I saw many years ago prior to Strategem, but I was chatting to a chief executive officer of a company down in Melbourne.
Yep.
This is probably 15 years ago, and he was earning quite a lot of money at the time, but he also revealed to me that he had a $50,000 credit card debt. And I said to him, how do you accumulate $50,000 of debt on a credit card? And he said, I say yes too often. So yes to the overseas trips, yes to the BMWs, yes to eating out, yes to the update, the wardrobes. So he says yes a lot. And then the following day, I was chatting to a factory worker that was earning probably a third of what this CEO was earning, maybe even less. And when he showed me his balance sheet, he was miles in front of this CEO. And the reason, and their incomes were very different, but their savings habits were very different as well.
It's that contrast, isn't it? Love to talk about a couple of examples of clients that you've helped over the journey as well. I mean, you've seen many clients and helped them in many different circumstances, but there's probably a few that really stand out to you as ones where it was like we're able to help them and create value for them in a way that just was unfathomable otherwise. So I'd love to hear a few of those stories from you on just some of those clients that you've really helped in different situations.
There's been a lot over the years, but there's a few that stand out for various reasons. A couple came to Strategem probably about 10 years ago now, and they're still a client of ours. But their understanding of financial matters and in superannuation investments was fairly limited at the time. So it was very much an education piece to start with.
Yep. And do you find that a lot with clients? Like there is a real, it's not just do this, but it's actually, let me explain to you the benefits of, let me explain to you how this works and things like that. And people actually go away feeling more informed than when they start. I think there's a real power to that.
Yeah, no, that's where I tend to start. And I know you like the whiteboard, and I do as well.
Love the whiteboard.
You get up on the whiteboard occasionally and do a few diagrams. But
a picture's worth 1,000 words.
It is. Yeah, but this situation does stand out a bit because they're already an existing client of Strategem Tax and Accounting.
Okay.
But they were new to the investment services team. So, I got in front of them. I sort of understood their circumstances and what they had invested. And I, again, started to educate them about, okay, well, where do you want to go? This is what we need to do. But it was very much a consolidation exercise initially as well, because I think combined, they probably had about 6 different superannuation funds.
Right.
So we
so 6 different sets of fees.
6 different sets of fees.
6 different investment profiles.
6 different benefit statements. Yep. There was just a lot of paperwork, and they weren't exactly sure what was going on. So we consolidated all that, and we made a significant saving on an annual basis on fees.
You can miss a real picture on their their wealth as well too, can't they? Because they're going, oh, I feel like I've only got this in super, but they forget they've got 6 different accounts where if it's all together, you actually get a bit of picture of where it's at. So saved them quite a bit on fees.
Saved a significant amount on product fees by consolidating. They wanted more control and flexibility over their superannuation as well. So a self-managed super fund suited them.
Yes.
And again, they've had that for 10 years or more now. And another aspect to this was that she inherited a lot of shares from her parents. So there was a big share portfolio sitting in her name, and her tax bill on an annual, her personal tax bill on an annual basis was starting to get up there as well. So we decided to transition assets out of her name into the self-managed super fund.
Love it, because I think that's another key piece, isn't it, for advisors when we're looking at that strategic piece is where's the structure at? Where are you paying tax unnecessarily? Are you building wealth in the wrong vehicle? Essentially putting the handbrake on the ability to expedite that growth and really utilise what you've got.
Yeah, correct. So, moving assets away from marginal tax rates into superannuation where it's taxed at a maximum of 15% in accumulation phase or in pension phase 0. So, we did the long-term forecast on if you do this over the next 10 years, gradually drip money into the super fund, keeping aware of the contribution caps.
Yes.
I think we worked out there was something like $100,000 tax saving to them by just moving assets from one entity to the other. And then, as I said, there was significant cost savings on the product as well.
So let's roll through. So coming and getting that advice shifted them from paying unnecessary fees, paying unnecessary tax, essentially $100,000 of tax savings, but then you've also got the product fee savings as well, and then you've got the fact that there's that compounding interest scenario where that $100,000 is also reinvested. Those fee savings are reinvested, so it's just an exponential calculator worth of benefits that come from getting the right advice and putting you on the right track. Yeah, no,
it was a great solution initially. And as I said, they're long-term clients. Great clients as well. But look, there's been a lot of clients over the journey too where I've rebalanced portfolios and taken a bit of risk out of the portfolio.
Which is, how do you go with that conversation? Because I remember leading up to the GFC, like I came in just as the GFC was starting to occur, and there was a lot of people saying, I don't want to sell. I've seen 30% the last 3 years. I don't want to sell anything. So it's very hard sometimes to book the gains that have been made. So how do you go with that conversation?
I'm old enough to have witnessed a few ups and downs over the journey, right? So global financial crisis, kicked in late 2007 and dropped 50%. The Aussie market dropped about 50% and it bottomed out in March 2009. But prior to November 2007, I think it was 4 or 5 years, the Aussie stock market didn't deliver anything less than 15% every year.
Huge.
So it's 15, 25, 20...
But if we go back to that long term, well above the long term as
so
well.
Above average returns. But unfortunately, what a lot of people do in those sort of situations, and I'm kind of seeing a bit of that now, is they chase returns. And as you say, they don't want to back away from those really strong returns, but it's not a normal return. As I said, the long term normal return from the Aussie stock market's about 9% or just over. So there's been a lot of rebalancing of portfolios over the years to say, look, you're just taking on far too much risk at the moment, and I like delivering these sort of returns to you, but if you've got 80% in growth assets when your risk profile suggests you should have 70 or maybe even 50, you're taking on far too much risk. So when things do come off, you're gonna see it in a very big way. How about we take a bit of risk out of the portfolio and just bring you back to your comfort zone? And that's what it's all about. I want to make sure my clients are able to sleep well at night.
And how many times have you been able to call the top of a market, Brett?
Never.
How many times have you called the bottom?
Never.
So, and this is where I see it is sometimes there's this belief that we might have this crystal ball or that we know what's going on. And it's like, no. We follow rules because trying to chase a crystal ball will never work. Like no one's ever rung a bell at the top. No one's ever rung a bell at the bottom. Everyone's always known with hindsight where it is. And I think that's one of the things is don't try and chase the bell on either end. Just go, I need to have those principles that I keep putting in place day after day, week after week. And
stay true to your investment strategy or risk profile, no matter what the market conditions are doing. Because if you try and time the market, you might get it right, but 9 times out of 10 you're probably going to get it wrong.
Yes.
But we've seen some really strong returns of late, and there's conversations happening now where I'm suggesting to clients that, hey, maybe we have a look at the growth that you've seen over the last 12 months, and maybe just pull that off the table and bank it. There's nothing wrong with sitting in cash for a short period of time. You don't want to be in cash too long, but there's nothing wrong with taking a bit of profit off the table and just parking it.
Yep. No, I think that's wise advice. And people forget sometimes that cash in the hand also gives you options. So, like during the GFC, I remember people who held probably too much shares at the end of the day. Then if that's their retirement money and they need to live off it, all of a sudden when they need that money, they're being forced to sell things in a down market rather than actually having cash on the side, which goes, I've got cash here. I don't need to touch those shares. I don't need to sell that to do what I need to do. And I think people forget that side of it, is that if you're all in, you've got nowhere to go. There's no options. There's no cash out to the side, that emergency fund or whatever. That means that you're not forced at the wrong time to do the wrong thing.
That's exactly how I'm positioning portfolios at the moment. Let's have an attractive cash balance, and ideally, particularly when you're in pension phase, you want to have at least 1 year or maybe even 2 years worth of pension payments sitting in cash. Because
that can include term deposits.
Any liquid assets that you can get your hands on pretty quickly. Because as you just mentioned, if we do have another significant downturn where markets drop 30, 40, 50%, you don't want to be forced to sell assets as they are falling. No. You want to just ring fence your cash and just have all the other assets sitting to the side. And you can just let those assets go down. And we know, history's shown, that they always bottom out and they always recover. But another just more recently, I'm just about to present some advice to a couple of new clients tomorrow.
Great.
So this is fresh in my mind, but they got a fairly significant superannuation with a retail super fund.
Yes.
And they're in a geared share fund.
Wow.
Right. So their risk profile suggests they should be in a growth fund. So they should have around 70% in growth assets, not 100% and geared.
So we're talking 120, 130%.
Yeah, depending on what the gearing strategy is behind the scenes. So they're taking far too much risk on their superannuation. So again, markets have been really kind to us of late. So their balance have gone up significantly. But they're now entering retirement. So I'm just finishing off the advice this afternoon. I'll present tomorrow, but their fees are combined. They're about $28,000 a year fees. So I'm suggesting, look, let's move away from that particular retail superannuation fund. Let's go to a managed account structure. So full transparency on how you're investing, and the fee outcome, I think combined, is about $11,000 per annum.
Wow.
So again, these clients are sort of 64 and 62, I think. So if you translate that annual saving over another sort of 20, 25 years plus, it's a significant saving.
Huge. And more transparency, reduce risk to the portfolio, able to sleep at night, because if you're in a geared scenario and that's what you're living on, there's a real risk that what happens if we have a market correction, because it's going to be twice that on the gearing side. So you're going to have negative returns. That's great. Just thinking forward too, we've talked a bit about how the industry's changed, a little bit about where we're at the moment. Where do you see the next 5 to 10 years for the advice space, and where it's going? What kind of clients we'll be seeing, those kind of things?
Oh, well, look, I think it's a really positive industry to be part of, because yes, we've seen a lot of advisors fall away of late because of
think nearly 50% of the
it's
advisor base has disappeared.
It's a big number, yeah. So as education standards have been raised, a lot of advisors have thought, well, I don't meet that and I can't be bothered meeting that, so I'm going to exit and do something else. So anyone coming into this industry, I think it's a great growth area, and we've got a couple of young guys in our team, which I think have got a great career in this business. And but yeah, I think at the end of the day, I say to clients, what I do is a relationship game, right? Yep. So if a new client comes into Strategem, they've got to feel comfortable with the business, but they've also got to feel comfortable with the people they're dealing with.
Yes.
It's a relationship game. So, you can go next door to the next advisor and you can pretty much get a similar statement of advice that will tell you how to structure things, how to invest, all that sort of stuff. But at the end of the day, it's a relationship game. So I think as technology comes on board, even more, I think that relationship aspect of what we do will just continue to grow. I think most people want a face-to-face relationship with an advisor. They don't want to be dealing with a computer. And look, some aspects of what we do, the computer might be able to take over a little. But at the end of the day, when I have a look at my client base, I mean, if I said to them, you're not going to be seeing me anymore, I'm going to have some sort of technology solution for you, they wouldn't be happy with that. They'd be looking...
Here's Siri 3.1.2, give you advice going forward. Yeah. And I think probably one of the things I've seen in that technology space, which is interesting, is that it has biases. It still has problems that haven't been solved yet. And I think sometimes it's people really want someone they can talk to, someone they can call up and will actually understand them on an emotional level as well, because a lot of what we deal with is quite emotional. Like when people are going in retirement, they're essentially saying goodbye to the life they've had for 30 years, 40 years, where they've got out of bed each morning, gone somewhere, done something. All of that disappears. The income from that job disappears as well. So there's a lot of change that they're dealing with, and you really need someone that can guide you through that process. And I think I know that's what we see on a regular basis, is people either getting ready or entering retirement, because that is where we can help them the most, and that is where there is the most change for them as well too. And they essentially go from, I've worked all my life to build these assets, to now these assets are going to fund my life,
the rest of your life. I have a lot of clients that say to me, thank you for what you do for us. We really appreciate it. And again, it's that personal touch, it's that relationship. But it's a real growth area. Look, at the end of the day, we have an aging population here in Australia. More and more people are starting to retire. They need to lean on someone that can help them through those retirement years, from an investment perspective, but also from a Centrelink perspective as well. If you're eligible for an age pension, you can apply for that. But we've found more recently that it's quite a involved process. And then looking even further on, aged care is becoming a fairly big aspect of what we do as well. And we've got a couple of aged care specialists in house. So if anyone needs advice there, we can direct them there.
It's not necessarily the person going into care that we're dealing with, but the kids who are having to deal with
family members,
mum and dad now going into care, and what's the best financial outcome for them? What's going to make most sense for them? What are they going to have to be forced to sell a house? All these things that come up. It's a lot.
Yeah, so there's a lot going on, and sorry, just another client.
Go for it.
Outcome, which is worth mentioning here too, is estate planning is another aspect of what we do as well. So
what happens when I'm not here?
What happens to your assets? But one that's been getting a bit of media attention of late is the taxable component of your superannuation. So again, a good news story on one of my clients is that I pointed out to her that, look, if you pass away, your kids will inherit your superannuation, but the tax man will take about $250,000 tax before they get anything.
It's quite a hidden cost, isn't it?
Yeah, so it's the 15% tax on the taxable component, or the 17% tax, depending on how they get it. So yeah, just recently we made we sold down assets inside the super fund. We made a significant lump sum withdrawal.
Yep.
So the assets are no longer in the superannuation system, so there's no taxable component.
Yep.
And then we've invested that into an investment bond, which is again, a tax-friendly investment, only taxed at a maximum of 30% as opposed to a higher marginal tax rate. And if this client does pass away, well, the kids get the entire balance.
Okay.
They get the entire balance. So the tax man doesn't step in and take $250,000 away from her hard-earned cash.
Yeah, and I think those hidden taxes people just aren't always aware of, and it's like there are strategies to mitigate this, but you need to get on the front foot and start working on that. Otherwise,
seek advice.
Yeah, exactly. Brett, I'm just conscious of time. Have you got any last take-home messages for anyone listening out there? Anything that you want people to just sort of remember as that final piece of advice for them in this space?
Yeah, I think it comes back to the education space for me, Kris. Again, a lot of what I do is educate my clients. So yeah, just have an understanding about where you're at, where do you want to be, and what do you need to do to get there.
Yes.
And just like what I told my daughter to, do something.
Yes.
And as I said, it doesn't have to be big. It's not like you have to invest $1,000 a month.
Yep.
You can invest $70 a week. But
Just
if you
start.
do that over time, it develops into a big balance.
Yep.
But yeah, do something. Another one that I always talk about is pay yourself first. So that comes back to superannuation. You can salary sacrifice some of your superannuation or some of your income into superannuation. So you'll pay 15% tax as opposed to a marginal tax rate that could be in the 30 or 40% range. So yeah, do something, pay yourself first, and just understand what's going on and seek advice if you need to. Because from my experience, we can identify some issues that we can help you with.
Great, love it. Thank you so much, Brett. It's been a pleasure having you on. It's been great to hear the journey, hear how you're helping people along the way with all of this as well too. We're going to include your contact information in the show notes.
Great.
Being a Strategem alumni, obviously you're on the website as well too, so people can jump on and see you there as well. But it's been great having you on the show. Thank you for coming on, and to everyone out there, make sure you go and get the advice that you need. So thank you.
Thanks, Kris.
Thanks.